it's Rebecca Lynn Matheson, aka the Canadian Cottage Girl, and welcome to the Canadian Real Estate Channel. Today we're joined by Josh and Ehren from the Findlay Mortgage Team. Welcome to the channel, guys.
Thanks for having us.
Absolutely, always a pleasure. Well, today we're going to be talking about how to buy multifamily real estate in 2022. It's a hot button topic, and I'm really looking forward to hearing your take on this topic and really diving deep into it today.
So as of right now, Erin and I have seen a significant amount of our clients move into this multifamily space. There really isn't any money to be had for holding assets that have single units or even duplexes, triplexes in the GTA Golden Horseshoe area, just due to the asset valuations that have increased over the last year, 2 years. Everybody's moving into the commercial market or the multifamily space where their income doesn't necessarily need to support the debt they're looking for anymore, which is causing a really dynamic shift from an investor standpoint as to how they go about getting their financing. There's many different products and services in place now to help people buy these assets because the majority of the multifamilies you're looking at the market right now are underperforming or under rented. So how do you go about buying these things? There are a handful of different types of financing that you can do.
First of all, if you haven't already, make sure that you like this video, throw us some love in the comment section below, and subscribe and turn on that notification bell so that you do not miss a single episode here on the Canadian Real Estate Channel. So welcome to the channel, guys.
Thanks again for having us on.
Absolutely.
Phenomenal to be here. You'll notice that if you watch our content, that a lot of our content is focused on multifamily assets. And the reason why we're making this video in 2022 is because the market is changing. And we wanted to give everybody kind of an update as to the financing options you have, what things are looking like for repositioning assets, what products are out there, and how you can go about doing it. So this is kind of like a refresher to outline what the market is looking like in 2022. So as of right now, Erin and I have seen a significant amount of our clients move into this multifamily space. There really isn't any money to be had for holding assets that have single units or even duplexes, triplexes in the GTA Golden Horseshoe area, just due to the asset valuations that have increased over the last year, 2 years. Some areas have 30% appreciation year over year at the moment, so it's very difficult to attain any sort of cash flow at that point. So everybody's moving into the commercial market or the multifamily space where their income doesn't necessarily need to support the debt they're looking for anymore, which is causing a really dynamic shift from an investor standpoint as to how they go about getting their financing. There's many different products and services in place now to help people buy these assets because the majority of the multifamilies you're looking at the market right now are underperforming or under rented. So how do you go about buying these things? There are a handful of different types of financing that you can do. We did drop 2 videos previous this year. Highly recommend you check them out. One of them is called the multifamily repositioning product. It's our own proprietary product that helps you kind of acquire and reposition into a more secure conventional product, and the other is all about the MLI Select product, which is a CMHC long-term holding product. That both videos have tremendous amount of value, so if you haven't watched them yet, I highly recommend if you're looking to get into this type of space.
Absolutely, yeah. I think it's really important to understand all of the different strategies, and like Josh said, make sure that you hop over to some of those previous videos if you haven't already. We'll make sure that we link those in the description just down below so that you can get the full scope of some of the different products that are available for multifamily investing here in 2022. But as you said, we're creating this video today just to really give a high-level overview as to what's going on in the market and what that looks like here in 2022, because this market has changed, I would say almost monthly at this point. Like it's changing so rapidly. Where the market was at in 2020 or 2019 is so different from now. So you have to stay up to date and relevant on what's currently happening right now.
Yeah, I think, 2 biggest things to talk about in 2022 is increased prices and increased commercial rates. So we're shooting this video in March right now, and in the last week and a half, we've seen commercial rates qualifying from 3.69, 3.8 to now we're qualifying at like 4.5 to 5.2. You know, the cost of commercial funds has been going up quite drastically and quite rapidly, and we've seen quite a few increases on the commercial rates over the last 3 months. So, you know, one thing we were talking about is if you purchased a building a year ago, 6 months ago, and you were running your numbers based off these, it might be time to revisit, make sure, hey, are we still on track to be able to get that refinance done and still be able to qualify at the loan to value that we're looking at, or are we going to have to readjust our numbers, maybe look at, turning over an additional amount of tenants, or, are we looking at additional amount above the market level, and just making sure that, hey, we're still on track to get this 75%, especially if you're in some sort of high leverage private situation and you really were relying on that higher end takeout. The prices, we're starting to see sellers kind of build in the fact that they're selling a building that has the ability to be turned over. So not only are you getting just the higher cost of the market, but people are now becoming more in tuned from a realtor standpoint, maybe telling the clients, hey, look, this building is undervalued, it has low rents, quite a bit below market level. People are going to want to buy this because it has this ability. So maybe instead of selling it here, we can get a little bit of extra premium on it, and that's it's making it a bit more difficult. So it really is pushing a lot of investors over to acquiring these buildings in 2 ways. One, you're either acquiring it with a large down payment, you're 40-50% down, or you're acquiring it with a private mortgage solution that's going to bypass the need for a debt servicing product, allow you to get in, take a year and a half, maybe even 2 years depending on the size of the project, turn it all over, and then refinance back out into a conventional or an insured product, and and get it on that way. But definitely a little bit of challenges, and it is going to require some creative solutions.
Absolutely, yeah, and we'll talk about some of those creative solutions today and some of the trends that are happening, but I think it's really important to highlight what you said there, Ehren, just in terms of strategy and the fact that as an investor, you're always looking to create value and get a return on the value that you've created. So by looking at buildings that are under rented, underperforming, you're able to force that appreciation and actually create value, and thus make a profit on that value that you've created in the building. So let's just break down a little bit more in terms of strategy, just based off of what's happening in the market as you highlighted, what investors maybe should be looking at now.
Sure, yeah, I mean, the number one thing investors should be looking at is your ability to be able to force appreciate a property. Now, that is the main reason why, well, not the main reason, but one of the main reasons why investors focus on multifamily assets. So it's really important to understand how you go about valuing these assets. So for like a regular home, for example, even a duplex, a triplex, or a fourplex, the value of that asset is going to be based off of the direct comparison sale of other assets in the area. So you could do a bunch of work to it. It might get a little bit, it might be valued a little bit higher than the other assets that are being sold, but at the end of the day, a direct comparison approach is probably the way in which a appraiser is going to value your property. Now, if you take a look on the other hand at multifamily, that's a 5 units and up, that's a commercial valuation. So they take a look at a capitalization rate, and that capitalization rate assesses the net operating income, and then from there we create value through that. So a lot of investors like the idea of being able to force appreciate the property through being able to raise that income, and there are a handful of different strategies to be able to do that. You can check them out in other videos and talk to other investors who have done it, but having the ability to keep your finger on the pulse and raise the value whenever you want is a very powerful thing to be able to control. And I think a lot of people are moving into understanding that is a better way to be able to force progress along your journey without necessarily needing to either claim more money on your taxes or personally debt service the debt. And what a lot of investors are doing is they're doing this in like a corporation, or they're doing it in a tax controlled environment that's going to allow them to be able to maybe personally achieve the goals that they want. So if you want to buy a house or build a house in the future, if you hold these assets in a corporation and you structure it properly, you're going to be able to do those things. Whereas if some investors who were previously just purchasing duplexes and triplexes in their personal name, taking on all of that debt in a personal name, it's great when you can just qualify with Scotiabank and do an offset and just get it done really quickly with no cost. But down the road, what does your long-term and short-term goal look like? So a lot of people are just moving towards sheltering that and allowing them to be able to have the best of both worlds, create wealth while still being able to enjoy their life.
Absolutely. Yeah, I think that that's all really important points to highlight. Is with multifamilies, you are able to force that appreciation, and that's really the name of the game here with these multifamilies. Is if you can add value, then it's a great property to invest in. If it's already at market value, then you have to look at, is it performing or not? And I think that that's really where, when we get into larger units, those numbers can really help with the assessment of the performance.
Yeah, you take a look at, there are definitely strategies or people who just like the cash flow aspect of larger buildings. And unfortunately in Ontario, it's becoming more difficult to be able to get that cash flow most investors are looking for. So we're seeing a mass exodus of multifamily investors who are looking for turnkey assets, moving to out east, out west, in the States, where the cost per unit is much less, but the actual rent control and ability to be able to have higher rents and higher cash flow is an actual, they have the ability to do it at the moment, which is a reality for them, which a lot of investors who are looking for that turnkey asset just aren't really focusing on Ontario anymore, unfortunately.
Right, absolutely. No, that makes a lot of sense. And now, we talked a little bit in some of the previous videos that we mentioned just about some of the products that are maybe trying to solve some of those problems within the multifamily space. So maybe what from those products do you think are going to be trends that we'll see in that multifamily space, just based off what the government is putting out, or CMHC, or what's happening in the market?
Yeah, I think first thing when you're basing your type of product, it's like where are you investing and what type of cap are you buying it at? Because if we take a look at Toronto right now, Toronto is sitting at 2.5 to 2.75% cap. So I mean and then taking a look at Kitchener, Sarnia, Windsor, Sudbury, wherever it is you're investing at, you got to take a look at how the whole market is going to shift, in unison. If Toronto's already at a 2.5. And you're buying at a 3.9 or a 3.5, and you got to take a look at, for you to be able to increase your value, like where do the cap rates have to go and how does that market have to be shifted? How much room really is there for you to be able to get that forced appreciation done? And then that's going to kind of determine what strategies you're going to have to use, whether it is simply just cash for keys and just turn it over, and maybe you're buying at an aggressive enough cap rate that there's room for you to be able to just increase the income and get it there, maybe some small renovations, or is it going to be taking an 8, 9, 10 unit, maybe they're bachelors, maybe they're singles, and doing some renovations, adding another bedroom. You might have to take that 10 unit and drop it down into an 8 or 7 unit, but are you effectively able to increase the rents high enough that way, or is there enough room in the market rents to be able to just cash for keys and keep the amount of tenants that you have in there? Obviously the other options that we've talked about in terms of which way you're going to go is taking a look at CMHC type options, taking advantage of the higher loan to value, but also the higher amortization. The standard rental product, you can get up to a 40-year amortization. With the new MLI Select product, you can get up to a 50-year amortization. Those higher amortizations are going to be able to allow you to help mitigate some of that cash flow loss just by spreading out those payments a little bit and trying to keep more of that back in your pocket. I particularly like the commercial real estate because a lender is only going to give you, at least a conventional lender is only going to give you the mortgage if your building is cash flowing. So there's many times that you can, on the residential side, just leverage your personal income, leverage the income from your other rental properties to be able to make an application work, but it may not be cash flowing on a specific property. And if you've refinanced your property at all over the last 2 years, 3 years, depending on how many times you've changed your tenant, you've probably lost that cash flow that you had at the beginning of the year. Whereas on the commercial side, it doesn't matter how many times you purchase or buy a building, purchase or refinance a building, every single time a conventional lender gives you a mortgage, it is cash flowing. So you're making positive money. So when you're in an appreciation type market and those values are shooting through the roof and the rents just aren't quite keeping up, if you're focusing on cash flow, getting into that commercial side is going to at least ensure that you are making consistent cash flow. And I think that's where the commercial real estate has its strengths, and taking a look at how effective long-term is it at putting money back in your pocket, even going through, or a lot of investors call it recession proof, and people are always going to need a home to live in and a roof over their head, and having that cash flow even through down markets is going to be great. Whereas the appreciation type investor, you're really riding the market, and even though it is cyclic and you can time it, that cash flow is going to be there. I think really the only tricky part you get with the commercial financing is that it's not as simple as just, okay, my building appreciated, now I'm going to go take out that equity. You can only take out that equity if you've increased the income on the building. So it's not as simple as a residential BRRRR where you go out, you buy it, you convert it to a duplex, and then you just leverage your own income and you can pull it out. You know, if you turn over a building, you could go in and sink, you know, $200,000, $300,000 in renovations, but if you haven't been able to increase that rent at all, net operating income at all, you're not able to really afford any more mortgage, because unless you're able to drastically reduce the expenses, of course. But so that is really the only tricky side with the commercial, is that you do have to, you know, increase that rent accordingly to be able to get that value. But you know, in terms of holding onto an asset that's cash flowing, a commercial mortgage is really the best way to go.
Absolutely. And it sounds like the strategy is to hold on to these buildings rather than try and do all of these renovations and sell it, because who's going to buy it once it's at the top of the market value in southwestern Ontario or southern Ontario from that point. If you have a building that you mentioned is really like turnkey, there's less buyers for that just because you're forcing that appreciation. But if you can force that appreciation, hold on to it, pull out that capital and do the next one, you're really building a multitude of kind of long-term wealth, really.
I think it's an interesting concept that you brought up, is, you know, and we've talked about this, that I think that there is a very short amount of time at the moment, but within the next few years, I think, that the average investor will be able to purchase or do these types of multifamily buildings, specifically because debt servicing. So the average income is only going to be able to support so much rent. You're not going to be able to have $3,000, $4,000 a month rent. It's just not going to happen. Income isn't going to increase that much, although your building values will. So even through just appreciation of the market itself. So you're going to have a point where all these buildings are only going to service at a certain level. So you're going to have investors or groups of investors who are going to have to be able to put very large down payments down to get into these buildings and acquire them, meaning you're going to have a ton of dead capital. It's going to take a lot of investors out of the market, in the Ontario market, because the majority of people who are looking to invest don't have the luxury of burying millions of dollars into buildings. So I think you're going to move into a situation where just large conglomerates or REITs or, you know, people who are extremely ultra wealthy are going to be able to buy these assets, and the average person won't be able. It won't be attainable anymore. Right,
absolutely. So if you can get one, hold it.
I highly recommend. Yeah, I think it's a great investment at the moment, because real estate isn't going anywhere.
Yep, that's a great point. And I think when we look at all the different types of investment strategies, it's one that is tangible. You can go to it, you can feel it, like that, you can smell it, depending on what kind of building you buy. So I think that is a really important point that you make. It's not going anywhere, but the affordability is. Like, that is going to continue to change. So if you can get into a building where you can create value, force that appreciation, then you can hold on to a fantastic cash flowing asset and be able to leverage that asset into other things. Thanks again for tuning in, guys, to another episode on the Canadian Real Estate Channel. And make sure that you check these guys out on the channel on the Findlay Finance Fridays here right on the Canadian Real Estate Channel, but they also have a whole nother YouTube channel that you have to check out, the Findlay Mortgage Team on YouTube and across all of the different social media platforms. I know that you guys always put your information just in the description below, so is that the best place for people to reach you, or what's your preference in terms of social media, phone? What would you like?
Yeah, phone, social media, emails, you know, whatever's easiest for you to connect to us. We respond to all of them, so whatever works.
Awesome. Well, guys, if you haven't already, make sure that you subscribe to the Canadian Real Estate Channel down below. Smash that like button on today's video. It really helps us out, and it feeds the algorithm. So make sure you smash the like button and throw us some love in the comment section below, and we'll see you on the next one. Peace.